All right, good afternoon, everyone. Can I please have a quick sound check? Just want to make sure that everybody can hear me. You guys can see the screen. All right, good afternoon, everyone. So how's everybody enjoying the day today so far? Tons of information, tons of awesome information, right? Okay, hey guys. All right, so let's get started. Today we're going to talk about volatility. So is volatility good for trading or is volatility negative for trading? So we're going to talk about this. Okay, sorry about that. So I'm just coughing here. So just give me 1 second. Okay, I'm so sorry about that. I had COVID in January and I'm still having that aftermath cough. Okay, so today we will be talking about how we can profit from volatility, right? Can we really profit from volatility, or is volatility going to work against us? And now we're going to dig deep into this workshop, talking about volatility and kind of like depicting and seeing what goes into this volatility, what creates a volatile market, and how can we trade a volatile market. So unlimited income, simple patterns, and turning pain into gain, definitely with volatility. Hello, everyone. My name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade the futures and the equities markets. I have been doing this professionally for the last 19 years, and prior to becoming a professional independent trader, I come with 10 plus years in investment banking. I also specialize in high velocity moves, which means that I'm calculating the points of maximum flow to the upside or to the downside, whether I'm long or short, to make my time worthwhile into the market. I'm also the designer of an institutional proprietary trading system that is actually a fusion between price support resistance, the many layers, the 8 layers of price support resistance associated with specific trigger times for day trading, but also for swing trading and investing. And also I take into correlation the specific price zones and chart synchronicity and divergency. So it's a fusion between, excuse me, all of these systems, all of these strategies that enable myself to identify patterns with ease, patterns that are predictive for these high velocity moves. If you guys want to get a hold of me, you can reach out to TradeOutLoud.com. You can email us anytime at info@TradeOutLoud.com if you have any questions about any of our services or programs or anything that you may have interest in. And you could find us on social media, and our handle is TradeOutLoud. Here's our agenda for today. The advantages of deploying different strategies, day trading and swing trading. So what is best when you're having a volatile market? Should you approach it long-term, medium-term, or as a day trade? For example, you get in and out within the same day. The next step, and what is the next step that you need to take to protect your portfolio? And I do have about 10 points that I'm going to give you here today, so you'd protect your portfolio in case of market volatility and when the market is volatile. And how long will volatility last? And is volatility here to stay? The first signs of volatility actually came in 2018. And since then, the market has never been the same. So we have been going through these really heavy volatility cycles. Are technicals still working? Because it seems that when you're having a volatile market, when you're getting a tape bomb, when you're getting news, definitely the levels are being breached. So how do you find points of entries, points of trailing in your trades, whether you're day trading or swing trading or even investing? And also day trading versus swing trading in volatile markets, and how to adapt as a trader. So if you lost money in the 2008 market crash, and by the way, how many of you guys in here were trading the 2008 market? Type a 1 in the room if you were still in the market trading in 2008. Just want to know my audience a little bit. Wow, you guys are really young. Okay. Wow. Nobody was trading in 2008. Wow. Okay. I was trading in 2008. I was trading way before that, a lot way before that. Hey, Jeff. Okay. Makes two of us. All right. So if you didn't take money, if you didn't, if you literally lost money in a 2008 crash, you were trading, Valerie. Awesome. All right. So if you didn't make money in the 2008 market crash, and obviously if you didn't take advantage of the rotation that happened, and if we have time today, I really don't know if we have the time, but if we do, I'm going to show you something that is going to blow your mind in terms of technical analysis. Let me just get that chart ready, set for you guys in case we do have the time. Okay. So I'm going to show you something that's really going to blow your mind off in the SPX. And I think I'm going to show it right after this slide because it's too good. Okay. All right. So I'm going to do that. All right. Get it ready. Okay, cool. All right. So if you didn't make money in 2008, shorting everything, waking up and say, okay, what am I going to short today? If you didn't short Lehman Brothers or financials in 2008, and then you took the rotation back to the highs, you missed a great opportunity. But guess what? You know, volatility came back again, and volatility came in 2018. And since then, we have been having like this really wild, crazy market. But how about 2020? How many of you guys? Oh no, Silver. Oh gosh, I hope you're okay. I mean, the fact that you're here shows that you're okay. Sorry to hear that. So yeah, you guys are really young. Okay. So how many of you guys were trading 2 years ago in 2020? How many of you guys were trading in 2020? Type a 2 in the room. Type a 2. How many of you guys were trading in 2020 during the pandemic? All right. Now you're talking. Okay. All right. Don't forget, guys, to enable all everyone instead of just panelists and hosts. Okay, because I'm the only one that can see your answers. All right. So many of you were trading in the 2020 pandemic, and in fact, that presented another massive trading opportunity to the downside and still to the upside. Remember, as traders, we can both trade long and short, and that's why it's so super important to have different types of trading accounts. Even if you have a retirement account, right? In a retirement account, you cannot short, but you have a retail account in which you can short, and this way you can hedge your positions. Guys, it's time, news flash, it's time to make 2020 pay, because there are huge opportunities. And I know with every crisis, and I'm sorry to say this because I don't like crisis at all, because it affects everybody. But there are huge opportunities and a lot of money that are being made during these types of situations right now. All right. So before we actually get into earnings, I just want to put real quick here. So I promise, let me know if you guys can see the chart. I'm going to pull out the SPX here. This is the S&P 500. And what I'm going to do is I'm actually going to go to a monthly chart. Okay, so I'm going to go a little bit way back. I'm going to give the maximum amount of time here that I can, not only 15 years, but I want to do max available. All right. Okay, you guys ready for this? All right. So the market is obvious. Can someone name the trend that we're in right now? Can somebody name the trend? Are we uptrending, downtrending, or are we sideways right now? Can you guys answer that? What is this chart telling you? Is it uptrending, downtrending, or is it sideways? All right, exactly. For those of you that have answered uptrending, it's definitely uptrending. You see a correlation of higher highs, right? You see higher highs. You see a massive correlation into the higher lows, right? Even with this pandemic, this is the pandemic high, this is the pandemic low. And here you just have literally you have a 2-bar pullback, because the bar that we're having right now, I'm not going to zoom it in just now, but the bar that we have right now into this monthly chart is an inside bar, and we're still trading above. We don't have any lower lows and lower highs, and that makes it a massive uptrend on a higher time frame. So if you're a long-time investor, a long-time trader, you have nothing to worry about because the monthly chart and even the weekly chart are massively bullish. There is no downtrend in those massive time frames, correct? All right, so what do you guys see here? So this chart started, started printing, the way I have it set up here is for the max available data. We have 82, 83, 84, blah, blah, blah. Okay, so we're going higher. So starting with 94, obviously the tech companies had a big jump right here. And this is the tech bubble, right? This is the tech bubble. This is the .com bubble. And all of a sudden we came into resistance, right? We were right on traction. We started to move down a little bit and we have established high, lower high, lower high, lower high, lower high, correct? So we have breached the moving averages. I'm using just very simple moving averages, the 20, the 50, and the 200. So you're seeing that the price has started to trade below the moving averages. So this is the .com bubble. This is the first time when the market literally was hit by massive volatility, right? And everything started to fall apart. As dramatic as this was, right? But we got a rotation and the price was still trading above the 200 simple moving average. And you guys know that institutions like to buy above the 200 simple moving average. It's still a very desirable area. And it is still looked at as being positive and being bullish. So they're accumulating into this area. And as with any investor, they like to scale into their trades. Soon enough, we actually formed a double bottom formation. Now, I'm not going to zoom. Let me see if I can zoom in just a little bit here. All right, just give me 1 second. No, because I won't be able to see that. Yeah, we won't be able to see the highs. Okay, so I'm just going to leave it like this, squished. All right, so you see a high, you see a low, you see a double bottom. This is the time for the rotation. And in fact, this happened in 2003 and we head on to our merry way into a financial bubble, right? So within the financial bubble, what was the financial bubble problem here? Technically speaking, we're not going to discuss, economics, fundamentals, or anything like that. Technically speaking, the price came right into the .com bubble. And obviously there was some turbulence and divergence into that spot. Is that right? Correct. That's right. We had the housing problem and therefore we had the financial crisis. So what happened at this point? Technically speaking, we have reached resistance, correct? We have a double top formation. As dramatic as this pullback was, guys, as dramatic as it looks and as scary as it was, because it wasn't literally scary. Remember, the value of the houses were going down. You were living in a $400,000 house. It was priced at $200,000. So it was very dramatic, but as dramatic as it was, if you're a technical trader, if you look at the market, it was nothing but a retest into the prior lows, right? So this is a huge support band that we have, right? It was basically back into resistance, back into support. So this is what analysts and this is what institutional traders are looking at. Now I'm going to share something that is really awesome because I've been trading, I've been running, I've been running my company way into the, and I was trading well before that into the 2020. So my footprints are seen all around these charts and I was trading them. In fact, I do remember, for example, here, when we started to move down, I would get up every morning and I would say, okay, what am I going to do? What is my game plan? Because usually you have to have a game plan if you are a day trader, if you're trading stocks. So my game plan was, okay, short financials because they ended in really weak win bars. Win bar is a really heavy, solid red bar, whether it is, and that's a heavy weak bar, win bar to the downside, or you could have a win bar that is, for example, a green bar that pushes to the upside. So what else do we see here? So we see a double top and a double bottom. Now, for example, if you're good into your technicals, you go to your fib tool and what do? You trace some levels to say, hey, once you have this rotation and once you have this pivot formed into the support level, you want to make sure that you know exactly with high odds where the price is going to go. And you obviously know that when the price is going to get into this 200 simple moving average, because this was a mega confluence level. So from this point on, the price could have started to move down, right? Because the price went up here. Oops, sorry about that. All right, so the price went down. Here we go. All right, I zoomed it too much. All right, now these are at a level. Let me just clear them out. All right, so you got it. You have a double top, you have a double bottom. And here you have the rotation. So when the price moved back into the upside, for example, here, okay, I can't trace that for some reason. That's odd. Anyway, so when the price came from this low to this high into the 200 simple moving average, it could have turned around. So it could have went lower, but it didn't. And it consolidated consolidated here for months, guys. So you can look at the candles 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 months. So it has had a consolidation, and trading was pretty treacherous at that time, but there were still plenty of trading opportunities, right? So what do we do? What do we make out of these double tops and double bottoms? Well, there's one way to find out. We pull out our fib tool, and that's what I did exactly at that time. Because as soon as I saw this rotation in the market, I was moderately bullish on everything. And once the price started to hover above the 200 simple moving average, every time we got a pullback in any of the major stocks that were heavily declined within that crisis, I started legging in. And that was the time when I started legging into NVIDIA, into Cisco. The prices were so cheap, into Sirius Satellite. So I actually took Sirius Satellite. It was trading at 15 cents. 15 cents. Now it's trading like in the dollars. All right. So what we do is we actually want to find out if the market is going to continue higher, where is it going to go to? So I had this trace level, and I have multiple charts with multiple extensions. And I looked at the fact that if we start knocking out the lid off of this resistance area, we have plenty of room for a continuation higher. And we did. And remember that in 2014 through 2016 was the dullest period to trade. Trading was very flat, was very narrow, and it was not very volatile. We did have some element that we're going to talk about later in the slides today, in the presentation today. So they're really well represented, so you understand what happened within this context here, because you see some wicks to the downside. But you can see that we had basically formed a massive range again. So we have high and we have a low. We have a revisit almost to the prior low, and we have a revisit almost to the prior low again, and we have these highs. Now, post-election, we started to explode. 2017 was very aggressively to the upside, was a phenomenal year. So what trend are we in here? Very much bullish, correct? Very, very much bullish. So finally, we projected higher. So we knew, and the price knew, and the technicals were on our side, because regardless of what happened, once you have a technical breakout, and if you have good narrative, and in fact, we did have a plethora of very good events through 2017, lower taxes, this and that. So we had a lot of elements that were helping the market. Guess what? The market went higher. Guys, look at this pivot right here. You cannot make this up. There's a science to trading, and trading is math. So if you're looking at this pivot high, it came exactly to this 261.8% fib. And then when you got the pullback, you got the hook into the 10 EMA. That means that you're into a power trend traction. Moving averages were fanning out, so you're in a power trend traction. So the price was poised for a continuation higher. What happened here? Well, we're going to talk about that in the presentation, but we had a pullback. We had the first sign of volatility that came in. This is the first sign in January that we had, January and February. And then we had the other volatility that came into the last quarter. We had November, we had October, November, and December. The turnaround happened, guess when? Santa Claus rally. You see this low right here? This was printed a day before the Santa Claus rally, before Christmas, one day before Christmas. And then we had this massive turnaround, and again, another breakout. And then we had the pandemic, which was considered definitely a pandemic, but it's considered from the market standpoint a news event. Do you guys know what a news event is? Is a brief interruption in a massive trend. It's noise. It's just a bunch of noise. It's a brief interruption into the massive trend. So we had this pullback here again, plenty of trading opportunities here. And then we have the price back into the 261.8% fib, boom, back to the upside. And here we are right now. So what do you think do you think that there is more upside to this? And in fact, there is. There are extensions way above that. But why are we holding this area? We have just 3 bars down. And you can see here that the price action is subsiding a little bit. So the price action, definitely, it's a very young candle. It's only 9 days old, and this is supposed to close at the end of the month. But definitely, you see a narrowing in the price action, and you're seeing that that momentum is weak because it's contained between the prior candle high and low, and it's also contained by support into the 433%. Right? So that's how I look at the market. I'm going to take this out. That's how I look at the market. And that's how you can forecast and time your trades, especially if you're a longer term trader. And definitely it helps even if you're a day trader, because once you see that the price action is visiting and revisiting and revisiting and stabilizing into this 4,200, this becomes predictive for a buy pattern, even for day trading. So therefore, you're going to narrow it down to your 1 minute, 2 minute, 5 minute, 15-minute charts. And you can actually trade with confidence because you know we have a really substantial level of support. All right, so what else creates volatility? Let's get back on track here. What else creates volatility? Earnings reports, right? So earnings have a huge influence into our trading. Now the volatility from earnings is not as high, and that is because we are in, we can see here that we are definitely in week 5. So we only have about 3 weeks left into the end of the quarter, and companies are not going to be as active, and especially the companies that have a high impact in influencing the market and the market indices, and definitely correlating the market with potential moves. For example, I'm talking about Google, I'm talking about Amazon, stocks that definitely can lift the market with it. Now, before we actually get into more volatility, I want you guys to make a little note here. So this volatility is here to stay, especially for the month of March. Volatility is being created as well this week. And one of the reasons why this week, let us, and just leave aside everything that is Ukraine, everything that is war. This is still typically a very volatile March, and especially this week. And this week, we have the contract that is going to start rolling, the futures contract, the futures indices contract that are going to start rolling on Friday. So on Friday, the volume from this March contract is going to start dripping into the June contract. So what happens next week is going to be the big doozy, where we have the quadruple witching option expiration, where you have everything on the face of earth that is going to expire, right? Including the futures, indices, stocks, etc. So options on stocks, etc. So that creates a lot of volatility into the market. All right, so now let's talk. Like every once in a while, the markets will become volatile for various reasons, whether news, geopolitical, elections, unrest, etc. So there are certain volatility cycles that you need to know and you need to be aware of. So we have the 2022 internet bubble, we had the 2008 financial crisis, the 2018 volatility exposure spikes, the trade wars with China. And we had some other technical aspects, more algos that were introduced into the London market, into the London market and into the New York market. And in 2020, we had the coronavirus pandemic. We also had the election at the end of the year. So it was a very volatile year. And then in 22, now we have war, inflation, and midterm elections. And that is going to produce, again, a very, very turbulent market environment. So volatility is the amount of unpredictability or risk in an index, stock, commodity, etc. A higher volatility means that the security value can oscillate in a larger range of price. So you can see that when you're looking at the technical chart and when you identify a setup, the setup, for example, if you're trading futures, let's say NASDAQ, and a regular setup, if you were trading in 2015 or 2016, it would be for about 5 points. Now that 5 points represents about 120 points right now. So that's, let's say, inflation on the stops, right? So exactly, and the same thing is into the stock market. You see, for example, a setup in Apple that, let's say, a swing setup in Apple of about a couple of dollars. Now you're having $5 all of a sudden because of the volatility. The bars are wider. You have you have wider range bars. You have really, really big wicks. So you have to make sure that you take that into consideration when you're looking for a setup. In other words, the price of the index, the stock, the commodity, etc., can have a higher average fluctuation rate over a very short period of time. A lower volatility means that the index, stock, commodity, etc., value does not move dramatically, but at a normal pace. So that goes back to even last year. Last year we did have volatility, but it was not as bad. We were coming out of that big volatility that we were in 2020. So is volatility good or bad? I think that volatility is great, but the only thing is that you need to be knowledgeable of your risk and your risk management, because identifying setups is not going to work as well, because you have to take into consideration the risk. Because when you trade, You have to be accountable for your risk. All right, so here is an example of volatility in the SPYs. When you see like wide range bars like here, right? You see topping signs again here, and you see wicks to the upside, wicks to the downside. The bigger the wick, the bigger the volatility. So that's a signal of increased volatility. The acceleration of the move lower is caused by, so whenever you are getting, so the market you saw that is into a massive uptrend on very high time frames. We're not talking lower time frames here. We're talking a weekly, and we're talking dominant trends. So typically the market is following dominant trends and not really small trends. So the acceleration is caused, that lower acceleration, that big sell, the bleeding to the downside. What does it cause? Who causes that? What causes that? First of all, trailing stops. When you're in a trade, you made money into that trade, right? And you are lifting your stop up because you don't want to go negative on your trade. You don't want to go to break even. You don't want to go, after you made, I don't know, let's say 10% in a stock, you don't want to put your stop, let's say at break even. You want to lift it a little bit. You want to protect, let's say 5% or 8%. So you're lifting your stop up. When the price hits your stop, you're not the only one that is going to see that technical level. So there are going to be many levels, many traders that are going to see pretty much the same area. And they're going to put their trailing stops or stops around there. So what this happens is that when the price is going to hit that pressure level, those trailing stops and stops are going to get triggered, and that creates the snowball effect because it's just going to continue lower and lower. And that's when the panic starts. Algos are hitting hard shorts because algos are going to take the, instead of the bullish facet of the coin, they're going to turn to bearish. So you're going to stop out, the algos are going to hit, and they're going to start shorting and massive institutional liquidation because they cannot exit a position at one level or two levels like we do. What they're going to do is they're going to have different stops in place, different trail stops in place. And when they're going to trigger out their big positions, 1.2 million shares or 800,000 shares, that is when the snowball effect is really going to happen. And there's also another thing that creates the volatility is the margin calls. This is the VIX. This is the chart of the VIX. I also like to take a look at the VIX in correlation with the market. The setups in the VIX are very important for me. This is a small time frame, so you could just see the choppiness and the volatility and the chaotic price action that we're having in this chart. So what causes volatility and what really triggers it? Well, we know that the geopolitical context is very important for the dynamics of the market. A calm environment is going to put the market into a nice transition to the upside or to the downside, but a turbulent geopolitical context where you have war here, unrest there, you have other things that are kind of like iffy all around the world, things are going to get very choppy, and the market likes certainty. The market hates to be in uncertainty and hates that pressure. So therefore, there are a lot of people, there are a lot of traders that are going cash. Funds, hedge funds are deploying much more conservative approach to trading. Maybe they're not taking as many positions. So there are a lot of things that are happening that are either slowing down or making the traders and institutional traders play some trailing stops. Also a climactic hyperextended move in the market, the one we had in 2017 to 2018. So in 2017, we almost went parabolic up, right? Everything was uptrending, everything was roses, everything was going up. And all of a sudden, when we had some kind of conflict, the market started to shake a little bit, and that created the first spike of volatility down. Earnings reports, like we talked earlier, anything that is coming out of Washington will create volatility. And in fact, you see someone, if there is somebody talking, you're going to see that the market is like holding its breath. It's not doing anything. It's not going up. It's not going down. It's just holding its breath. And then you have the algo programs that create the volatility. Remember, 87% of the market volume is created by algorithmic trading. So therefore, algos are creating a lot of volatility into the market because they're liquidity providers. And of course, pandemic issues, these are still going to be a very big concern as we're moving forward. So is volatility good or bad for the trader? What do you guys think? What do you guys think? Is volatility good or bad for the trader? Well, there are pros and there are cons. Let's talk about the pros first. You have tremendous technical opportunities, obviously, into the market if you know how to calculate the market, how to calculate the timing, how to apply and deploy different strategies. Money is being made in a fraction of the time compared to the traditional market moves, right? Because the market is super fast. Profitable for short-term traders, for day traders. And in fact, there are periods of time when it's best to be a day trader. That's why you have to have two hats, right? When the market is very volatile, for example, the way we had it in 2020, it is best to put your day trading hat and have a short-term approach to the market, because you have no idea what's going to happen 3 days from now or 10 days from now into a pandemic. So day trading is a really nice approach to have. So you have to be this global trader. You have to be this very skilled trader in which you know how to juggle different styles of trading, day trading, swing trading, active investing. And as price seesaws back and forth, you know, to chop the fleecing effect, short-term traders can use chart patterns and technical indicators to help time the highs and the lows with much more accuracy. Because newsflash, when you're getting a change in the trend, a shift into the momentum, the smaller time frames are going to be the ones that are going to be impacted first. And there's going to be that snowball effect from small time frames to large time frames. Okay, so when that snowball reaches a support level, like we are, like the one we are in right now, for example, on higher time frames and support, right? Then you're shifting back to the upside, and then you have to look for the clues for the change in the trend. There are some cons as well. So 95% of the traders blow up their trading accounts, right? So wide stops create this huge price oscillations. Setups become a lot more difficult to take, and oftentimes they don't work the first time around. So you're getting into a trade, you deploy the right strategy, and all of a sudden you're getting the shakeout. Now, institutions sometimes do this in the morning, and this is something that they're known for doing, especially into the indices. If you're trading the Qs, the SPYs, if you're trading SPX, if you're trading futures, they do a forced sell. For example, when you're changing the shift from a volatile market that took the price from a point A higher to a point B lower, and when you're getting that shift in momentum, you can see that the market is just hitting the brakes and is just trying to get its engine started to pop up a little bit. So when that happens, you're going to see that there are at the New York trading session open, because I specialize, I day trade, I swing trade, I actively invest in the market. But when I day trade, I specialize only in the first 2 hours in the market. So what I notice is that the price, when it's trying to get off the ground, it's making a little progress in the overnight trading, and then it's stalling in the New York trading session. And then when the New York trading session opens, it becomes fleecy. So that's the fleecing time. It goes back and forth, back and forth. And whenever it's getting a setup, and in fact, I did have a trade today, I'm going to cover that in a second. What we did is we took it long, and then we have the fleecing effect, and I stopped out of that trade. It's always a great idea to use make stops, use stops in volatile markets, because if you're wrong, you know, on the trade, it means that you're going to get stopped out, which is not bad, because you're just losing one bullet out of 3 or 4 for a day trade. So it's always healthy to use stops. What they're doing is that they're forced selling. So the mechanism behind this technique is, and this is done again by institutions, is to sell. They see the buy orders, they see the strategy, they want to get in, but they don't have enough size. So what they do is they start shorting. They know where our levels are. Obviously, I think we had that discussion yesterday. So we know, they know where our levels are. They trash through the levels, right? They clean all the levels out, and then they buy, and then they lift the price back up. What do you think this happens? What this does to the market? Instead of having a stop, for example, of, I don't know, let's say 20 cents, okay? Instead of having a stop of 20 cents from, let's say, the buy point to the stop, all of a sudden right now you're having $1.20 stop. So they're increasing the risk size, because they know that traders would not go for that kind of risk, Okay, so that's some of the games that they play. So one of the other cons is that you can expect multiple stop outs. And inexperienced trader can lose a lot of money in these volatile conditions. Stops are very wide and makes it impossible for retail traders to participate and impossible for small account holders to take any trades for days. All right. So let's take a look here. So I gave you a little peek and a little insight into the SPX earlier about the projections that I think it was mind blowing to see how we traded with confidence. And how I traded with confidence through this whole entire pandemic, knowing, and obviously through the 2016, end of 16, 17, and so on, trading with confidence to the upside because the technicals were there. And that is reinforcing, and that is reinforcing our strategy. Well, let's go back here a little bit. So we were talking earlier about that range that happened from 2015 all the way to 2016. There are a lot of things that happened then as well. And as boring as it seems here, because it's relatively sideways, you can see here that we had a volatility to the downside with the growth concerns. And then remember, we had the China unrest, and then we had Greece defaulting here. Then we popped back again here, and then we came back. Remember the falling oil prices. And then there were tremendous buying opportunities into the oil stocks and into the oil sector that actually did not present itself right now. Now was just another leg in. But the real opportunity happened in 2016, and it happened in March. I know because I'm in some long terms in my retirement account from these lows right here from 2016. And as you can see, the price went higher, and then we had Brexit concerns. Then Brexit, right? UK exited the European Union. Then we had the US election here in 2016, and then the market went higher. The first pullback that we had, volatility, came from multiple things, right? First of all, it was that constant China-US trade war. It was constant. Then we had inflation fears. We had North Korea fears. We had Syria. They were bombing Syria and all that stuff. So this created a very turbulent market environment. But what is the one common denominator that basically the chart pattern was following? And it was never, from long-term perspective and from the buying the dip perspective, because this gives you confidence and knowing exactly how to time that and how and what to look for when you buy the dip. You see this 200 simple moving average here, the red line. Every single time the price came near the 200 simple moving average, the market popped back up. And it came, and then it had the traction, and then it fell below the moving averages, the 20 again. And this was shorting opportunity all the way to the 200 SMA. Now you have the rotation and the tap. You have the price that went a little bit higher, pulled back, and then it's back on track into the trend. So once this hiccup is gone, the price got back on its tracks to the upside. And again, here, who knows where we would have traded right now. Maybe we're at 6,000 or 7,000 if we didn't have the pandemic, right? But this was the black swan effect, and this was the pandemic. All right, this was the pandemic. And for those of you that don't know what a black swan effect is, I do have a class. I do have a webinar on it. Actually, it's on my YouTube channel. So go to YouTube, Trade Out Loud, and then you will find it. It's actually, the slides are pink, so they're. I wanted to do something red, but I didn't find red slides, so I used pink. But it's close enough, right, to a bear market. And I explained what a black swan event and what this event was here, and how you could recognize that. And then the market went back to the highs. But wait a minute, this actually is into very close to the January 2021, right? We're in 22. All right, here it is. So remember what I was saying earlier, that this is the pandemic, right? Pandemic high, pandemic low. And then we started to move higher. Look at the traction. And now we're here. We have inflation, we have war, and we have federal rate hikes going on next week, right? So that's why the market is turbulent. Plus we have the contract roll. Plus we have quadruple witching option expiration. So these are things that are predictive. And that, yes, the rate hike is predictive, right? Because they talked about it. It's not a surprise. Not a surprise. The rates are zero, right? It's obvious that the Fed doesn't want to go negative. So it was only a matter of time before they raise rates. And I don't know why the problem with the market is and what the narrative is around it. So it's predicted from the standpoint of the Fed rate, of the contract rolls, of quadruple witching option expiration. And on top of that, inflation, it didn't pop now. It didn't pop this week. inflation was here since last year. So inflation keeps on growing and snowballing, right? And then we have the war. This is on top, right? And this creates a lot more oscillation for the market. So can you make money? Can you make more money in volatility, or can you lose it all? Okay. Well, in 2008, 374 hedge funds have closed their doors. In 2020, 79 hedge funds have closed their doors. In 2022, well, we don't know. We don't have the results yet. We're going to have it at the end of the year. But there are signs that there is a slowdown in the stock market, in the futures market. Brokers are raising margin requirements, for example, on crude oil. We had a raise in the margin requirement last week, and we had a raise this week. So roughly 11,600 hedge funds shut down worldwide between 2008 and 2020. And that's according to Bloomberg. So you want to see how we performed at TradeOutLoud during that period of time, because we have been trading the markets for a very long time, and we have track records, the good, the bad, and the ugly. All the trades are in there, the winners, the losers, the break-even trades, they're all there. So if you go to our website under services, you could actually tap into swing trading stocks or day trading futures, tap on those two services and scroll to the bottom of the page, and you can look at our performance. So identifying the best opportunities for every single day, right? As I said earlier, there are great opportunities for day trading, obviously, because you trade on a day-to-day basis. So for example, yesterday we had a long in Russell, and this long in Russell produced 26 points for us. That's about $1,300 with one contract. That is a really good day in this really crappy market. Now, today we had a trade in YM. We had actually two trades in YM. We had one trade in YM where we stopped out because of this chop. What I did this morning is I used a New York trading session low, and we had the hard sell that happened from the fleecing effect, right? I didn't want to really give it that wide of a stop here, even though I should have. So this is the type of ranges that you're going to experience, and these are the type of stops that you're going to experience. And then we had another trade, and that trade completed two of our targets. We definitely had targets much, much higher. And I see that now the market, now actually the price went past 75. 75 was actually a confluence level and a trigger point, a heavy trigger point that could have driven the price to 400. And in fact, it did. So these are two of the day trades. So for example, volatility, play the momentum, play with whatever is in play. Don't reinvent the wheel. It's easy. If they're talking metals every single day on TV, it's possible that you're going to have really good trades, for example, in the metal sector. I, for example, had the VIX long. I had also playing with the market volatility. We had mega profits in the VXX long. We had mega profits in gold. We had GDX that fulfilled all our targets, and GDX that as well filled all the targets for us. So it had these mega runs. Also, FCX is a play on metals. And actually, we had the entry point, as you can see here, as an extension from 100% all the way into the 127. Look how it traded technically. Look how it traded. And these are fibs, by the way. USO is a plate that I told you guys it dates back from 2016, even though it had different fluctuations, and even though it had that scary negative, went to negative in 2020 into the pandemic. But this is exactly what it did in USO. It went actually to about $14, I believe, or so. I picked it up at $16 in my retirement account, and I also took it in my swing trading account. In my swing trading account, I was in and out all the time. I was never out of the position, but I kept on adding, and I kept on offering out into targets, and then at the next pullback, I would add back in what I sold into targets. So I always had about half a position, or a little bit less than half a position, all the time into the trade. In my retirement account, that was it. So my entry was $16 and change. And by the way, look at it right now. Yesterday, I looked at my portfolio, and it was like with 1,000 shares, it was way over $84,000. That's with 1,000 shares. So there are great opportunities into the market, whether you're a day trader or a swing trader. And what I keep on saying to my traders is you have to have both hats on, because the market environment may not be favorable for day trades one day, but it may be favorable for swing trades. Because remember, in a high trending market, it is very hard to have pullbacks. In fact, in 2017, if you were not invested into, and literally there were very few pullbacks that happened, and if you were not aggressive enough in your approach to trading, you would literally not have a lot to trade because you would definitely be chasing price, and that's not good. So there's show me the money. Here's the thing, there's always someone on the other side of the trade. Volatility is what pushes the price faster to target. It is the number one opportunity for the astute trader. And I have to agree, you have to love volatility. We have swing trades this week that have completed all 3 to 4 targets. We're already out by now, right? So it's only Wednesday. So I have traded the 2020 to 2022 market environment, the 2008 crash, and the 2009 market reversal. I've traded through the QE years, election years, Brexit, China trade wars, 2018 volatility, 2020 pandemic with massive gains. And here I am with you guys today. So I'm still into the market and trading every single day. So I can make money in every single market. Trading is an inflation or recession proof skill. And the fact that you guys are here today shows me that you guys want to learn how this is done and take advantage of it. You want to protect yourself and your family. You want to create wealth because this is the time. So day trading is for income producing. So I know we talked about, the day trading hat and the swing trading hat. So day trading is, guys, is for income. So if you want to produce income, this is your style of trading. You're in and out within the same day. You're focusing on small time frames. Whether you want to produce income or supplement your income, you could trade any market, trending markets, volatile markets, markets up, markets down. You could go long, you could go short, even sideways markets are tradable. Also, swing trading for wealth. This is now swing trading and active investing. I call it active investing because I like to be a little bit more proactive into the technicals with it. And that's coming because I have the experience from day trading and from swing trading. Now, swing trading is the type of trading where you don't watch every single tick into the market. The swing trading is where you are focused on bigger time frames. It is for wealth generating. You're not going to have access to your cash every single day. So for example, if I made today $1,500 in a trade, I can take my TD Ameritrade card, Visa card. I can go to a restaurant, have a nice dinner with my family. So I can use my money. Okay. When swing trading, you really can't use the profits unless you close a position. So typically swing trading means that you're doing a quarterly, let's say, a quarterly pull out of your account. Let's say if you need some cash, but this is typically the type of cash that you're evaluating quarterly, biannually, or annually. This is the type of cash where you buy a car, you do a down payment on the house. Income is you pay your credit cards. Income means you get gas, you get food, you pay your bills. So that's the difference between the two. So can volatility be forecasted? If there is a way, is there a way to know when we can predict volatile moves? Well, somewhat, although not with exact precision. Volatile moves are at times predictable, and the predictability comes from, you guessed it, technical patterns. So you have to be a really good technical trader. How many now? Not many of you guys have been trading, like I have, let's say in 2008 or even 2002 or whatever. But if you would have watched CNBC back then in 2008 or even 2010, and if you would have seen their type of commentary compared to, probably you could still do it on YouTube, look at a very old show, you will see like a huge shift, like a huge difference. Because, for example, Kramer, right? When Kramer would come on, he would only talk about fundamentals. He would talk, only earnings data and all that stuff. He wouldn't really tap into a technical chart. Now everything is technical. Everything. He puts on all the technical information. He brings technical analysts on. He brings everything as technicals. All right. So long-term investors will use hedging strategies to minimize the risk. They will either use inverse ETFs or the VIX. Medium-term traders will speculate on volatile moves by buying pullbacks into key reversal prone areas, support areas, and uptrending markets, and also use hedging techniques. So they will use a combination, and day traders will take both facets of the trade, right? They will go long, they would go short, and they will capitalize on very quick momentum moves. Now, what are the cons, right? So we saw that you have plenty of opportunities, from volatility. Plus, it pushes your trade faster into target, which is fantastic. That's instant gratification. So what are the cons of volatility? First of all, traders may stop out often because of the steep risk and because they need to maintain the long-term bias for trades. What do I mean? So when you have a pullback into support, as long as that support is not being violated, your obligation as a trader and as a technical trader is to respect all the rules in the book. And the book says that as long as the price is trading into support, you have to go long until the price and until the pattern proves otherwise. And then if you have another rotation that pushes down and you have a violation of that support, that's when you go short. Okay, so stops are by far wide, risk is high, reward levels have less odds definitely less odds of working, making the trade asymmetric. Okay, what is an asymmetric trade? An asymmetric trade is, for example, if you have if you're taking a stock and the stop is $3, and let's say your target is, your reward is 50 cents above your entry. So that's an asymmetric trade. So you're making 50 cents, but you're risking $3. Okay, that's a trade that should not literally be executed in certain cases. The markets move fast, and it's sometimes very hard to place a trade. I had that happen in 2020. So in 2020, the price action was super fast. Excuse me, was actually a way faster than what we have today. One of the other things is that you can experience slippage. So for example, it happened to me on Monday. I had a trade, I had a limit order in. The price never reached that price. However, it triggered me in. So you're going to get slippage, weird slippages to the upside or to the downside. I know it sounds incredible, and I talked with my broker about it. Guess what? A trade is a trade. All right, so here are the 10 steps to protect your portfolio. Write them down. Number 1, reduce your risk exposure. Trade less is actually making more. Be more diligent into finding trades and look for more clarity into your setups. Number 2, minimize your risk. So if you're risking a full size, for example, on each and every single trade, it's time to go half into the trade. So risk only half of your exposure on each and every single trade. Number 3, sit on the sidelines if you're not sure what the market is going to do. And sometimes you're not sure what the market is going to do because it's into that inflection point where it looks bullish above or bearish below, but not with clarity. Just sit on the sidelines. Number 4, do not ignore the news. So this is the time where you get your information left and right so you can find out why the price action is chaotic. Number 5, do not sit complacent in trades hoping that the price is going to reverse. One of the worst things you could do as a trader is take a trade. For example, you take a long position and then you're stubborn enough and say, hey, you know what, at some point the market is going to stop because there's support here, there's support here, there's support here. At what point you're going to place that stop? And of course, I think that when you do that, and when you do that kind of trading, you either have a lot of money and you could buy yourself out of any trouble, or you need to have really good experience with damage control. And this is something that I teach my swing traders and investors. The other thing is use hard stops in volatile markets, especially when you're day trading and swing trading as well, and place them a little bit below that particular area where you intend to put the stop, because the price oscillation and the fact that they're going to run so fast, it's literally going to the market is not going. There's some news that is popping out, and that's why I was a little distracted right now, because the markets really do not like the comments that are coming that the U.S. is never said that, is not approving the Polish planes for Ukraine, and the market doesn't like that. All right. So there are different things that you can use here, like damage control, that you can definitely dig yourself out of the hole. Diversification, this is very important. Don't put your eggs in only one basket to make sure that you take the trades. Look for the relative strong sector and trade with that relative strength. Also, non-correlating assets, do not put your eggs in one basket. Invest in high dividend stocks and prepare in advance for market crashes, and know how to time the market and know how to trace those institutional levels and also Fibonacci's that are very important, because a lot of traders are using these technical indicators. So they become really good areas where, the price may stall or may hit. Now, we have 2 offers for you, actually 3 offers for you guys today, because we talked a little bit about futures. We talked about stocks. This is something that I do on a day-to-day basis. I day trade 2 hours a day. And when after my lunch break, I come in front of the computer and I scan for swing trading opportunities. I use the alerts in my swing trade, so I don't have to stick around my computer all day long. We do have the Power Income Futures Day Trading course, and tomorrow is going to be the last day of the promo for it, and we have an early bird available that is not going to come back. It is an institutional grade trading system that is basically going to teach you how to trade stress-free. And not only that, you're not going to be on your own. I'm going to teach you the full course, everything that is entailed. I'm going to take you from student to pro trader. And I'm going to be holding your hands. So you're not going to go swim, right? Because I don't believe that, okay, you can teach someone how to fish and then send them fishing. No, I am going to teach you how to fish, and I'm going to take the fish and put it in your basket. Okay. So this is the type of trading that I do, because I wish I had this service that I'm providing to my traders. When I first started trading, I wish I had someone that say, hey, I'm going to teach you how to trade, but guess what? While you're learning how to trade, take only my trades and nothing else. So putting the fish in your basket. I'm going to teach you how to trade institutional levels, precise buy and sell zones, management and risk management, which is the most important. Like literally every single one of you here should definitely start looking into management and risk management first before you even dive into candlesticks. We also have Hyatt's patterns and setups. We teach actually 10 trading strategies, believe it or not, 10 trading strategies. We also teach you how and where to place entries, stops with laser shot precision, like to the penny, like everything is precise, mathematical, and it's easy. It's actually super easy. And we teach you something both in the futures course, in the swing course, and all the courses that we offer, how to put the puzzle together, because this is the big piece that nobody's covering. How do you take all this information, technical analysis, strategy, a buy setup, for example, how do you buy that? Right? Because a lot of traders are going to buy in a downtrend. A lot of traders are going to short in an uptrend, right? How do you stay away from not doing this? All right. So if you're interested in this, like I said, we teach the most powerful day trading patterns and how to exploit them for above average gains. We teach you the 6 major disciplines: the entry, the stop, the target, management, position sizing, trailing, etc. Market tempo, right? How many times have you guys taken a trade, place a stop, and guess what? In a short period of time, you got stopped out just to see the trade run higher 30 minutes later. Well, that's the market tempo right there. That's going to teach you when to take the trades, how to maximize your timing using key moving averages and other powerful indicators that are free, how to maximize gains and minimize losses using proper money management techniques, when to buy, when to sell, precise locations, advanced technical analysis. Guys, you won't need another technical analysis book ever in your life. Okay. We teach you everything from A to Z, what you need to do to trade with simplicity, with clarity, and with precision. We teach you everything, how to trade moving averages, how to use Fibonacci's, when to use Fibonacci's, on what time frames you should use Fibonacci's, how to time the trades and all that stuff. So everything is in there and so much more. If you guys are interested in the curriculum, if you're interested, obviously, in the class, you could shoot me an email and we will send you the full curriculum. What you get with the course, You get on-demand recordings. So the course is always live every single month. You get the recordings from the course, but for this Power Income Futures Trading course, you're always going to have free retakes. So because day trading is a lot more, is a lot harder than swing trading. So you need that personal approach because there are so many things that you need to keep in mind when you're day trading that typically you don't need when you're swing trading. So we're opening the doors for free retakes. Plus you have 12 mentoring sessions, guys, with me. Well, and in fact, next week, we're going to start the first one. That's why the early bird is going to end tomorrow for this. You have free unlimited retakes, support through your learning process, risk chart, platform layout, everything under the sun. Shoot us an email. We'll send you more info on that. It's March 21st through the 25th. It's a 5-day affair from 2 o'clock to 4:30. Early bird tuition is $5,999. Again, you get 3 months live training with me in the trading room, $1,000. I mean, if you cannot make $1,000 in 3 months, I mean, I don't know. Most of my traders make their money in the first weeks from the course tuition. Plus you get 12 mentoring sessions with me live every month, one per month. Also, you're going to be into the live futures trading room with me. The live futures trading room is from 9 to 12. Usually it's $299 a month. You're getting 3 months for free. If you guys are interested, say, hey, you know what? I know how to trade. I'm really good. I'm fantastic. I just need you to find me the trades and spoon feed me the entry, the stop, the target. I want you to trail it for me. Like I want to sip, champagne, and I want to eat caviar, and I want you to give me the trades. We do that for you, and we have a special for you. We have position sizing and money management video course for $1,500 if you sign up today. That's only available for today. Last, we have the online April 4th through 8th, the Wealth Generating Swing Trading and Active Investing course. This course is $4,999. The course is going to go up in price on April 4th to $6,999. This is the last time we have it at this price, and you can access the Stock Swing Trader for 1 year for free. And we have, the last but not least, we have a combo deal for you. So you could get everything that we just said, the day trading course for futures, that is applicable to stocks as well. And you could get the swing trading course and the active investing course. The tuition for both is $10,000. We take $1,000 off, plus you get all the benefits from it. So shoot us an email to info@TradeOutLoud.com for the bundle. You can visit also our website. And if you're interested in any of these offers, please email us info@TradeOutLoud.com. Thanks so much, everyone. And thanks, David, for having me here today.